Welcome to the Monopoly Mindset, the podcast where we uncover the strategies to build your real estate portfolio one property at a time.
We're your hosts, Tyler and Tommy, here to share our story of playing real-life Monopoly.
Whether you're just starting out or a seasoned investor, this is your go-to resource for mastering the real estate game.
So grab your board, roll the dice, and let's buy Boardwalk together. All right, welcome back to Monopoly Mindset, episode 46. Today we have a guest on who has probably asked to come on the podcast more than anybody else, and took 46 episodes, but he's probably also our biggest listener. I'm guessing you haven't missed an episode, but that is my brother Steve Brown.
Nice, thanks. Yep.
So
probably the least
today's going to be a little bit. Today's going to be a little bit different of an episode because Steve doesn't own any real estate and he doesn't really aspire to own investment real estate, at least right now in life. So we kind of just want to bring on somebody else that has a different perspective because as Tommy said in the past, like we would never, cut somebody down for investing in something, right? We kind of just preach like investing in general and real estate is our vehicle, but we're not necessarily saying that that's the only right vehicle. So why don't you just go ahead and tell us a little bit about what you do for work and how we met and kind of, you don't have to go into your investment strategy yet, but what that looks like for you.
Yeah. So, no, I wanted to even say before I got started, I'm glad you said about, investment vehicle, because we were kind of talking before this about, Tommy made a joke. He's like, I can't wait to have you on and just kind of tell us why you hate real estate or why real estate's so bad. Like, before I even start, I'll just say, like, I view real estate as an investment vehicle. It's not something I have, and I'm not here to say that I don't, or that I think what I'm doing is better, or like what I'm doing is going to get higher returns than real estate. Like, we can definitely talk about that later, but yeah, I'm definitely not here just to be like, oh, what I'm doing is right and what you guys are doing is like stupid or wrong. But my background is basically I'm an engineer like Ty. As Ty said, I'm his older brother. Funny enough, I knew Tommy before Ty knew Tommy. Me and Tommy went to school together. We're the same age, so we've been friends. At one point we were basically best friends.
I can still remember the first day that I remember meeting Steve, and I don't even know if Steve remembers this story or not, but we were at a baseball practice somewhere. What's the name of it? It's like a small city right outside of Coatesville, like a small little town.
Oh, Westwood.
Yeah, I believe it was there. And so we're playing baseball, and I had no idea who Steve was, but there was like this obnoxiously good athlete. Like no matter what this kid did, when he was running, hitting, like he was just crushing everything. And he goes up and he's like, hey guys, look, I can pitch too. And he throws like the fastest ball you've ever seen for being like 8 or 9 years old, like straight down the middle, and it's a strike. And you're like, damn, this kid is just an athlete. So that's my
funny.
First memory of Steve.
Yeah, except for I fell into that trap that I was 5'7" when I was 12, and I haven't grown since. So, yeah, but that's funny you say that. Yeah, so me and Tommy met when, like you said, when we were like 8 or 9 or something. But yeah, basically, I'm just a biomedical engineer. I work at a corporate job. Pretty much, I feel like I would be a perfect example of like a lot of the YouTube videos that you see, or if people here are into investing and looking into like stock investing, I'm kind of like the normal, boring Vanguard, Jack Bogle, or Warren Buffett way, where like I invest a lot of my money in index funds, a lot of S&P 500 funds. I do try to take advantage of a lot of tax advantaged accounts. I like to learn a lot about stocks, and I like to, like, honestly, after school, like one of my favorite things to like read and learn about is like the market in general, or econ in general, like what's going on with the Fed, and what's going on with inflation and the push and pull there between jobs market and the interest rates and everything. And I've become really interested in that kind of thing. But at the same time, I also still kind of follow the principles, the main principle, which is dollar cost averaging. and yeah, pretty much always buying. there's a there's one channel I watch. You guys probably don't know them. It's like the Money Guys, I think, show. So they're like a huge show, but like they say ABB, always be buying. So that's kind of like one of my strategies as well. I love buying. I don't really sell stocks. I'm not like a trader. I don't really invest in individual companies. I do a little bit, but we could talk about that later. That's more like for fun. But yeah, that's kind of
Yeah, and you introduced me to probably my favorite podcast right now anyway, which is Iced Coffee Hour, Graham Stephan. So you also kind of, even though he's a real estate guy, he made his money as an agent and as an investor, but he is very much also like you, of just like all his YouTube videos, like you say at the end, he's like, by the way, I highly recommend just like buying an S&P 500. But one thing I want to ask, and I mean, we've probably talked about it, but since you're not investing in real estate, do you have like a deep desire to leave corporate America? Because like all the people that we have on that are doing podcasts, that are spending time investing in real estate and like the whole entrepreneurial world, I feel like everyone has this goal. It's all the same goal, and it's to like leave corporate America, work for yourself, not necessarily retire at 30, but just like kind of do what you want with your time. Are you okay with working with like say for a corporation until 60?
Yeah, I'm glad you asked that. It's funny. Me and you talk about this, and I always say like working for a corporate, probably regardless of what your job is, unless you're like taking out some jobs like massive lawyers or like working on Wall Street or something. But like if you're an engineer and you're working in corporate America, like it's the best way to guarantee that you're going to live a middle to upper middle class life. Now I shouldn't even say guarantee, because if you're bad with money, then you're not even going to be able to do that. But it's, if you know, if you're diligent with investing and you're good at saving, it's the best way to live a middle to upper middle class life. The reason I think that's funny is because like there's no way that I'm going to have $10 million when I'm 35 years old working in, it's just impossible, right? Whereas you look at people that do real estate could potentially have that. I mean, I know that would be a crazy lofty goal and you'd probably have to get a little bit lucky, but I guess what I'm saying is like, yeah, working in corporate America it's a steady job. But what I've noticed with you guys and like the difference between what I'm doing and what you guys are doing is like, I know that the money race for me is slow and steady. I am very happy with where I'm at financially, and I'm very proud of like how much I've been able to save. I'm not going to say the number on this podcast, and by the way, I'm like by no means rich, but I mean I'm happy with where I'm at. No,
do it.
No,
it's funny.
No, I mean, so what you're talking about, me and Tommy refer to as golden handcuffs. I just sent him a post the other day from Brandon Turner, and it said $150,000 salary is the worst position to be in, because it's enough that you're comfortable, but it's not enough that you're going to be rich. So you're not going to go take a risk, because like if I made 25K at my job, I would have quit, flip houses, like try and do real estate full time. But instead I'm in this area where like I'm very comfortable, and leaving my job is like I would be losing out on a lot. So I mean, that's not what you're saying, but that's how I look at it. And maybe you just don't dislike your job, which is actually a good thing.
Yeah, no, so yeah, and by no means am I saying I like my job a lot. I get a lot out of work. I don't want to work forever, right? I'm not like sitting here like, oh, I like my job so much I want to work till I'm 70. But what I was getting at with that is like, yeah, it's almost funny that at least when we were younger, and it might be changing now, I don't know, but when we were younger, it was when college was a huge push. And basically what we were told is like, you need to go to college, you need to probably get a business or an engineering degree. And like, that's how you make money. And that's why I think it's funny that doing that is a way to guarantee being middle class or upper middle class if you're good with your money. And the reason I say that is because the reason me and you talk about this all the time. Like the reason to be rich, the way to be rich is to have your own company and to do entrepreneurship. And that includes real estate, right? Like becoming a landlord and doing what you guys are doing. Like, let me put it this way. You guys have the potential to have, say, and maybe these numbers sound crazy to some, but like you guys have the potential to have a net worth of 20, 30, 40 million by the time you're 60 if you work hard. That as an engineer or as a business degree, I would say is extremely difficult to do. You know, Ty, I think you'd say the same, but like a lot of the wealthiest people that we know are entrepreneurs and have their own companies, whether that be real estate or construction is a big one, or any trades really. It's kind of funny that trades make a lot of money. When we were growing up, it's like, oh, you need to go to college and stuff. And I guess I'm not, I don't know, I'm like rambling now. I'm not here pushing that college is a bad decision. I'm very happy with where I'm at. But what I was getting at is when I compare what I'm doing to what you guys are doing, is like, this is getting down into the root of it, where it's like, I already have my numbers in mind that I know, like, this is the percentage I can save. This is where my money's going to grow potentially based on some return, whether it's 8 or 9 or 10% return on like the S&P 500. And I can basically now do the math with a few assumptions and say, okay, when I'm 50 years old, I'm going to have this much money. If I work harder, I can get quicker promotions, right? And like, you know, level up quicker and make more money, sure. But I do view it differently, where it's like, if you guys work harder in real estate, you can like really
There's just no
level up.
stealing.
Yeah, there's no stealing. Yeah, right.
Right. And you're, I mean, Tommy's in sales, so he's not necessarily true for commission based, but like in salary, I'd say over the long term, the harder you work, the better the employee. You're going to make more. But like in the short term, it's not like you're going to work double and then make double. You're going to work double and then get like a 5% raise instead of a 3% raise. Now, Tommy, you're a little different, where if you work double, you could make double, I think, because like sales-based jobs or whatever. But
yeah, you can definitely make.
Sorry, go ahead.
You can make more income if you put more effort into sales, and I think that's one of the points that Ty was trying to make earlier too. Is like with our, with us buying real estate and having W-2 jobs, like one of our goals is to not have these jobs eventually, and like that's 10, 15, 20 years down the road. But we want to do that well before 65. And that's like the main reason that we're investing in real estate, is so that we can build that up. And then we could get enough confidence where, like Ty's talked about becoming an agent. I've talked about becoming a loan officer because I like that side of the house a little bit better. But then like you're kind of doing, or you're flipping houses, or you're buying more properties. And so like we can then take like a passion project of real estate for us and kind of turn it into a job. So we're like working, but doing something we like doing, instead of doing like, I'm not saying we don't like our jobs today, but it's just something that you're a little bit more passionate about, and we could do that more full time. And I think that was like one of the points that Ty was trying to bring out of you, Steve, is like, when you got started, it sounds like you're putting a ton of money into your 401k and like just you're working your butt off and just like investing there in your 401k. But like, what transitioned in your mindset from like taking the 401k route? And I'm curious if like you eventually realized like, hey, I want to retire a little bit earlier than 65. And if that got you to start like getting brokerage accounts and some of these other tax advantage accounts, like I'm assuming you might have a Roth IRA or Roth.
Yeah.
So
yeah, I can talk about like my strategy, and it's changed a little bit as I've gotten further along in my career. I mean, I think one of the biggest reasons it's changed, my strategy has changed, is just because kind of what we were just talking about, the further along you get in your career. I've been promoted a handful of times, so now I just have way more money to invest. So now it's, I mean, I think that's a big part of it, but where I'm at.
Just want to highlight that. You know how many people don't say that exact line? Like, hey, I'm getting so much more money, and now I have all this extra money to invest.
Right.
Well,
not a lot of people are saying that. They're like, oh, I got a lot of extra money to go spend.
I just want to add that Steve, definitely more than me and definitely more than Tommy, does not get affected by income creep. So like, he doesn't really change his lifestyle too much based on how much he makes.
Yeah,
which allows you to take that extra income and save it. And like, that's what everybody should do. But like, it also is very hard, and most of America falls into that trap. Like, you get a 10% raise, you spend 12% more. I just know from knowing Steve that he doesn't do that.
Yeah, and I have thoughts on that too. I know we're going to be bouncing around here, but I can just a couple of thoughts on that. I mean, I like to spend money on vacations, and I absolutely go on more expensive vacations now than, 5 or 6 or 7 years ago. But I also feel like there's certain traps that I see that people do that I don't do, and it's like huge for me. And Ty, we talk about this too, but like I feel like right now one of the biggest wealth killers is like like food basically. Like eating at home. I don't know. I eat almost all my meals at home. I rarely go out to eat, which sometimes I don't like. Like I talked with my wife about it, and I almost had to make a goal for myself. Like last year, I did make this goal, and we didn't do it. Where I was like, we should go out. Like we can afford this. We should go out to a nice dinner once a month. Like I made that goal for us, and we didn't do it. I'm not saying I'm like. I guess I want to be clear. I'm not. If anyone here like watches Graham Stephan, I'm not to that level. Like I'm not bringing soda to a restaurant because I don't want to spend $2 on a drink.
Well, you're
and
not
like,
even going to the restaurant, so you
well,
can't.
yeah. Like I don't know. Like now that we're getting into this topic, that's one of the most interesting things. Like when you guys, and keep me on track here because I feel like I'm now bouncing into so many different topics. But when you guys spend your time on real estate, I'm sure that a lot of your time is thought about, or a lot of your time is taken up thinking about, the houses you own or what you're doing or your tenants or what. Like basically, you're always thinking about real estate. I think that's what I've seen when I talk with Ty.
I mean, every single second of my life. It now mostly growth. I'm thinking about like how can I buy more houses and looking at Zillow, not like worrying about what I have now. But yeah, every second of my life, I'm thinking about how I could quit my job through real estate.
Right. And me, now I've thought about this too, because what I think about on a daily basis is like more of the things of like the balance between how much I want to save versus how much I want to enjoy my life now, right? Because I don't want to fall into that trap either of saving. I mean, I was trying to do a little math before I got on here because I'm not like obsessed to this point where I know my percentage, but I think I save between 45 and 50% of my income.
Yeah, that's
That's a
steep.
lot.
Invest.
Yeah.
But
So
at the same time, like I do still really enjoy my life, and I get to do a lot of things. Like I don't know, like me and my wife went to Europe twice last year. I don't know, we still do things. We travel. I just think if you are,
but you don't buy junk like we buy like junk. Like I don't know. I mean,
I will
I don't
say
spend
like
a ton of money either, but
I will say, and I think this started happening because I was moving a lot, and actually, we'll get into this too because I still rent right now. But I was moving to different places, and I think after a few years of that, I was like, I'm tired of buying stuff. Like, I just don't need to buy new stuff. And I'm not like a freak that doesn't have anything. Like, I have stuff, but I definitely am not like going on Amazon and ordering stuff all the time, right? Or like, yeah, I don't know. Like, so those are my two biggest things that I think I'm able to save money is like the eating out thing, because I just do the math on like, especially with these delivery fees and stuff. Like I just do the math where I'm like, I can see where people could easily spend $50 to $100 a day on eating out, and I think people do spend that. And when you're like in your 20s or 30s, like you start doing the math on that. Let's say it's even if it's 50, like $50 a day times 7 is 350 times 4 weeks in a month. That's $1,400 in a month. Like there's no way I spend, and honestly, it's probably more than that. Like, because I know you can easily spend 50 on just a dinner, but you start doing the math on like $1,400 times 12, and then you're like, right there, you can invest that. I don't know. I will say, so back to what you said about, yeah, for some reason, I don't know why my brain's like this. It's wired like this. I did like math when I was younger, so it's easy for me to see the compounding. But like, it was never hard for me to be like, oh yeah, I just got a 4% raise. I can now invest 4% more.
yeah. All right, let me take us back to Tommy's question. So one, Tommy asked, what made you transition from, or what made you open up a brokerage? And I can answer for him, and that's he maxed out his 401k and he still wanted to save. Correct me if I'm wrong.
Yeah.
So it's not that I think Tommy is constantly trying to convince people to lower their 401k contributions. So he's like excited that you're like putting money in a brokerage instead.
Yeah.
But he maxed it out. I don't know at what age, but then
so
you get a raise.
How many years were you like when you started and you're maxing out your 401k?
This is
a great question. 2 to 3 years?
No, honestly, probably not, because going back to what I was saying earlier, like an entry level engineer, to be honest, does not make a ton of money. I was actually looking the other day. I think my first year of working, I only invested the total year $5,000 in my 401k. Um, I was doing the thing back, and I will say the first 5 years of my career, I was uh, saving, but not as heavily as I am now. Um, but I was doing the thing where basically I would add 1 percentage point to my
Hmm.
contribution every year until it got up to. I started maxing it out maybe 3 or 4 years ago. Um, so
Yeah.
Okay.
So
yeah,
take us through like your strategy and like the age that you have in mind and your strategy of like 50 to 65 or whatever. And
yeah,
I know you know some like compound
sure. Yeah, I mean, I can tell
gain
you pretty
rules.
much what I do. Um, I can tell you right now, and some things that I'm worried about or that I'm not like perfect at because I'm not like I should also say this, and I don't know if I need to say this or not, but everyone says it like this is not financial advice. I'm like by no means a financial advisor, and this is definitely not like anything people should do. This is just what I do. But first, I can talk about my allocation, which right now I don't love, and it's not what people say, but I'm like I was thinking about it before the pod. I'm like 95% invested in the S&P 500 for my entire net worth. Which, to be honest, has been working out great. You know, as of filming this, what did we have the last 3 years? I don't know exactly, but it's like 24, 2 years in the 20s, and 1 year, I think last year was 17 or something. So, you know, that growth is almost doubling in 3 years, or at least really high. Um, it's been great. I have like 95% S&P 500. I have like 2% cash, which is that's one of the things I know you guys talked about this, and I wanted to ask you guys too your thoughts on emergency funds. But one thing that I run into, and I think it's the same for you guys, is like when you're hungry to grow. And I know it sounds funny that I'm saying that with just like investing, but when you're hungry to grow, it's hard for me to sit on cash because you guys even more so. You see that like cash, you can turn cash into money, but even me like investing, like I'm like, why would I have this massive amount of cash when I could be in the market right now? So I don't know.
Well,
I'm
and
all
a brokerage account's liquid too. So if you had financial whatever, you could sell stock and get the money tomorrow versus real estate, you get the money in like 120 days. But yeah, to your point, cash inflation eats cash. So
for
there's really
sure.
no reason to have, in my opinion, dude, if you have a brokerage account that you can just sell the stock and access the money, I don't think you need 6 months to a year sitting in a savings account getting 3%.
Right. Right. Yeah. So that's that. And then I have like 3% or 2 to 3% of mine is like just like I say phone money or whatever, where I just kind of like try to stock pick. I don't know. I recognize it's gambling. Some people think they can beat the market. I mean, I've done relatively well, but it's also because the market has went up insane the last 3 years. So like anyone that is like the whole trap. Like anyone trying to stock pick has probably made a lot of money in the last 3 years. So like it works till it doesn't. But um, the only thing I
Yeah,
want to say
you're
about
also
that, I was
sorry. You're also with the S&P. You're also assuming that you're gonna get like 8 to 10%. You know that over history, like you said, we had a couple 20% years, and over history, we actually have a lot of higher than 10% years, but then you also will have like a few negative years where you actually lose money. So
yeah,
like it's kind of normal, I think, to have a couple 20% years. And then you'll have those negative years, like I guess probably 2020, COVID or whatever, or like a 2008, we'll take all those 20% and just bring them down to 10 in like one
oh for
year.
sure. Like yeah. So there's this stat too where it's like, and by the way, I'm like I like looking into all this, so I have a lot of market stuff. Sometimes when you guys talk about the market on the show, it's kind of funny because I'm like, oh, I wish I was on to kind of comment on this or the Fed and stuff. But no, there is a stat, and I don't know the the exact number, but it's a 10% average. But the amount of times that the stock market actually returns 10% is like very low. It's like less than 5% of the times. I don't know. Jamie, can you look that up for us or what? But
I think we need Steve as a part-time producer, and he can just, we can ping Steve and like, yo, Steve, like, is this right about the market?
yeah, and what I mean by that is like I don't know the exact percentage, but what I mean by that is like exactly what Ty said. Like a lot of years it'll be 17, 22, 14, 10, but then it'll be negative 20. And then it'll
Yeah.
be negative 1. So it's not like a steady 1%. Now, I will say, and there is also a stat that everyone says 8% to 10%, but the last, like, I forget how many years, I almost don't even want to say this because I don't have the numbers, but the stock market, even the last 20 to 30 years, has been producing way more than 10%. It's actually, I think the S&P has been at like 13 or 14.
If you take out
Yeah.
I've seen that too.
Because there was some really bad periods in like the 80s and 20s and stuff like that.
So you're basically putting money into a brokerage, super safe, not a lot of savings because you have a quick access to a brokerage. And you basically, at least you've told me, maybe you've changed this, but you basically think that or your plan is to quit your job, have that brokerage money to last you until, let's say, 59, until you can access your 401k. Theoretically, you could drain your brokerage, right? Your brokerage could be at 2 million, take 200,000 a year for 10 years, and then you have your access to your 401k, which if you max it out for the next 30 years is going to be plenty of money.
Yeah.
Is that still what you're planning on doing?
Yeah, so I actually learned about this more recently, and I'm surprised I didn't know about this, but I learned about it a couple years ago that there's a tax law. Well, the tax law for capital gains only kicks in at, and I don't know this year's. Last year, and actually I also know the single ones because I got recently married. I can look it up right now, but give me one sec. Gains tax. So basically, the number that capital gains actually kicks in is 96,000, at least as of last year. It might be closer to 100 now, but let's just say 96,000. So anything under 96,000 of gains is not taxed, so it's 0%. That doesn't really apply to almost anyone because that includes your W-2, right? So like right now, if you make, let's just say a person makes $100,000, that counts. So anything above that's already capital gains tax. So most people, and that's like married, that's for married couples. If you're single, I'm looking right now, it's 48. But at first, when you look at that, you're like, oh, that doesn't matter for me because I make more than 96. Me and my, as a couple, we make more than $96,000. So whatever. But then I realized when you're retired, you're not going to have a W-2 anymore. And I kind of thought of this and I was like, wait, so, or at least you're not going to have a high W-2 from your job. You're going to have like maybe some dividend income and some other incomes. But then I was like, well, wait, so then doesn't that mean, your first $96,000 of gains is taxed at zero? And I've seen a lot of people, again, I'm not like some tax expert. I definitely don't have a degree or anything, but I've seen this talked about a lot. And apparently that's true where like, basically, if you retire early, let's say you retire in your 50s and you're making $0 from a W-2, you can sell $96,000 of capital gains, and you're paying zero tax on that. And when I say capital gains, that's literally the gain on your investment. That doesn't mean like if I had, that doesn't mean if I sell $96,000 of stock. That means if I sell 150, let's just do like some quick math here. If I sold $150,000 in stock, but I bought it for 50,000, then my capital gains my gain there is 100,000, which means I'd be paying tax on technically 4,000 because it's 96. But let's just say I wouldn't be paying tax on any of that. So that means like you're living tax free.
You subtract your basis first and then pay taxes on whatever's left over. So like if you have, let's just say you have 4 million by 50, and you want to take out 400,000 a year, but your cost basis is 2 million. I'm just making up numbers. So you really have 2 million of gains in your brokerage. You could take out 400 a year, 200's tax free, and then 200 is gains, but then the first 100 is tax free. So you're up to now 300K tax free, and then you have taxes on 100K, which is I think in the lowest. Like
the lowest, which is 15%. Like that's the other awesome thing is capital gains are not taxed as income; they're taxed as capital gains. So they're 15%. Well, it's zero up to 96,000, then 15%, and it goes really high. The next bracket, I think. Yeah, I'm looking again. The 20% doesn't kick in until you start making, I believe, 600,000. If this is right. So I mean, it jumps up a lot.
But so The one question I have, and like this is where Ty is right, where I get a little bit angry with 401ks, and maybe I don't know as much as I think I know. But when you have, let's say, I mean, in your example, you might be anywhere from $5 to $10 million with how much you're maxing out your 401k and plan to do so. But let's say you had $5 million in your 401k, you can only take out, to your point, like a little bit of money each year to live off of. Or if you wanted to say, say you wanted to buy something for $1 million, a nice fishing boat or something crazy, like you would end up having to sell like 1.5 million,
Mm,
right? To because you're only getting almost 50% of that if you try
yeah.
to get like a lump sum. And that's kind of what made me be a little bit hesitant towards wanting to max out my 401k. I mean, I did max it out for several years, but once I realized what it's going to get to, I started doing, kind of what my company match was and tried to build out like more towards a brokerage account. And like, I'm curious if that has any like, if that does anything to you. Like, would you ever think about dropping down to the company match and just loading up your brokerage? Because like the brokerage is what's going to get you to retire at
Early.
50
Yeah, you're
versus
right.
65.
Yeah, and just to be clear, one more thing before I move on from that last subject. What I was talking about is only applicable in your 50s, it's only applicable before you start taking out your 401k, because once you start taking out your 401k, that now counts again as income.
Mm-hmm.
So you'd be paying full capital gains back again on your things. But yeah, so that's just one strategy I had. But your question about do I want to? No, I mean, I think so. This is going back to our first conversation. Like one of the biggest differences between what I'm doing and what you guys are doing is like uh you're viewing your 401k as like an opportunity cost because you have another way to make money, and you're also viewing it as when you're in real estate. And like, don't get me wrong, I've listened to all your guys' episodes, and like the stuff you guys say is right. Like when you're investing on a house, you're using leverage, which is awesome. That's something I don't do. By the way, I should have said that. I don't have leverage. So like I'm already like, when I'm investing 20K, I have 20K working for me. When you guys invest 20K, you might, on a $200,000 house, you have 200,000 working for you. So like I definitely recognize that. But that might be why I'm not like, I don't have an opportunity cost right now where I'm like, want to pull that into my brokerage.
Because you're investing in the same thing, S&P 500, whether it's in a 401k or a brokerage. So you might as well get the benefits of the tax advantaged account.
Yeah.
Uh,
The
but
benefits are that you just get more growth. You're still paying taxes at the end, but your number that's growing is much larger. So if you invest $24,000 in a 401k, which is the max this year, 24.5, if let's say you invested that in a brokerage account, you'd be paying tax first. So let's say your 24,000 is really only 17,000. So then when you start doing all your math of like, okay, it's going to double every 7 years or whatever your math is, you're only building on top of 17 instead of 24. So that's why like the 401k is an advantage.
No, it's definitely an advantage. Like the point, like for me, it's the advantage at 65, and then like, all right, so
Yeah.
now you're 65,
Yeah.
and it's
well,
just
no, it's not 65. It's 59 and a half.
okay.
59 and a
The
half. Yeah.
minimum.
59, 59 and a half. That's fair. No, it's an extra 5 years, which is definitely retire. And there's other ways to tap into your 401k too. I've read people that say you can say, I want to take out $150,000 at like age 40, but you have to do that then for the rest of your life. And like, you can't change it or something. Like there's something else in your 401k that you can do. So there's a lot of variables to access the money slightly earlier.
I think
But I
another
just,
thing, like to answer your question, like part of the reason why I'm okay with it is because, and this is not like I'm not rich and I don't have a massive salary, but I am able to max out my 401k and still invest, uh, a significant amount of money in other places. So I think that's why if I was a little bit lower salary and if I maxed out my 401k and then I had absolutely nothing else left over, I probably wouldn't be doing that. Because to your point, like I would want that flexibility and that advantage. And part of what Ty was saying like earlier, I don't have a huge emergency fund, but I do feel comfort because even if the stock goes down, yes, I'm losing a little bit of money. And to be clear, I do have enough emergency fund, just not 12 months. But it gives me comfort having a brokerage account because that is for lack of a better word, it's not fully liquid cash, but it is rather liquid. If people here don't invest,
100%.
I'm sure a lot of people listening to this do invest, but if you don't invest in stocks, like you can pull your money and have it in your account within 5 days.
Yeah, I think the
Usually
only
shorter.
so I think that like the Dave Ramsey would argue that you should have an emergency fund because things going bad are all kind of lumped together. So you lose your job, right? Why did you lose your job? Maybe because the whole market tanked, right? There's a COVID, there's a housing market.
Yeah.
So now all your emergency fund that was 10,000, oh, it was invested in the same thing that you lost your job. So now your 10,000 is worth 6,000. So it's like that's how I kind of look at it, is like a bunch of things could happen simultaneously that are all caused from each other that maybe like I actually wanted to bring this up. I'm kind of playing devil's advocate here because I love real estate, but one big difference between you and me is there is nothing that could really happen that would wipe you out, like file bankruptcy. Well, you can't file bankruptcy, but like net worth go to zero. As a real estate investor and a young one, you take on a lot of risk and a lot of leverage. And even though my net worth is X, there's a legitimate scenario where my net worth goes to zero in the next couple years, right? Because I'm kind of being risky. Whereas if you don't have leverage, that's not possible for you. So I just want to say that, like, now granted, a lot of bad things would have to go wrong for me in order for that to happen. Like, I'm not like super risky, but like, I don't know, if there's a 2008 crash, all my equity disappears, all my house values drop to 30%, and then all my tenants stop paying their mortgage, I lose my job. Like, there's a very very small scenario where I lose everything, right? And that's for every entrepreneur basically has that. And you don't have that like mental thing in the back of your head that it's a possibility, because it's just not for you. Like, if you lose your job, you sell some stock, you live for 3 months, and you get a new job, and you will probably be fine. But and even during a crash, because you look at things as like 30-year investments, it doesn't even affect you. Actually, you probably will find a way to, you'll probably sell your boat and buy more stock when it's 30% off.
Where was I going to go with that? There was a lot of stuff I wanted to say about that. Oh, yeah. First of all, since I do have a large part of my investment in the S&P 500, basically the only way that I do go to zero, or that something very catastrophic happens to me, is if, like, and I know this sounds dramatic, but it is true, if the United States, like, as a country, like, I don't even know how to put it. Like,
and then we're all screwed.
Yeah, like if something very bad goes wrong, where we're like, we get attacked and we're no longer the country, and like all of our companies go under.
Well, yeah, sure. But like we're also screwed at that point.
It's funny that we're like laughing about this, but that is the scenario that, like, people that invest, like, that is the scenario where we're like, okay, in that case, I would be in trouble. But
well, that's why they say you should have like 20 to 25% in overseas market, so that
absolutely right. That's
and why I do my 401k just because Dad told me to.
You're right.
I did that because your dad told you guys to do that, and I did it for a while, and then I just said screw it, and I went more Steve's route, where I think like 60 or 70% I'm just in the S&P 500, and I'm like, you know what, it's a little bit more simple, I'd rather just put it there. The return felt a little bit better. I think the other 25 or 30% I have is in like a 2060 fund for retirement or something.
Yeah, I view it as gambling, to be honest, and it's kind of funny that I view what I'm doing as gambling, but like, because it is like a safe way to do it, but a safer way than like exactly what you were just saying. But yeah, I mean, having 95% of your allocation in the S&P 500 means you're basically betting that America's going to keep doing well for the next, and like, I'm hoping I live another 60 years, so the next 60 years. Now, right now, since I am gambling, I will eventually move my allocation. And to your point, yeah, most people, I guess the ideal allocation would be 90% stocks. For someone my age, like 90% stocks, 10% bonds, and then people do usually a 70-30 split between US and international. I do 100% stocks, 100% US, but I mean, whatever. it is easier to think about. But no, I think the underlying thing, and I don't know if we've necessarily said it, is like the underlying difference between us. There's two differences that I see, and I kind of texted this to you guys and summarized it in like one sentence like a couple weeks ago. But I was like, the underlying difference between us is like, I do not have to stress about my finances. I do not have to stress about going to zero. I don't have to. The biggest thing is I don't have to work like on my investment. To buy a stock, I use Vanguard brokerage. To buy a stock takes 30 seconds or less, and I do that once a week. My 401k is automatic, but then I dollar cost average into the S&P once a week with whatever extra money I have. And but compared to you guys I see are working a lot harder than I am because I'm doing nothing technically. But on the flip side of that, like there is a cost to it, which is that you guys have the potential, I believe, to be making a lot more money than I do in the future. Right. And I think like the simple answer to me is usually like the simple answer is right. And the simple answer when you talk about stocks versus real estate is that usually, especially in the US and stuff, like the harder you work, the more money you're going to make. And I think that is also the answer for real estate. Like I'm not here to say real estate's dumb because I don't think it is. I just think that it's a lot of work. It's a lot more risk. And if you put in the time, and this is coming from somebody that's not done it, it's just from me seeing you guys and seeing other people talk about it. Like if you put in the time, you're probably going to make more money than I'm going to make by taking the stock investment route. But I mean, I think people have to answer that question for themselves. What do you want to spend your time on? I see you guys also kind of enjoy it, right? Like it's almost like your hobby, at least right now.
It's like I enjoy problem solving, and as certain problems come up, or like just working on my portfolio and trying to look at, ways that I can eventually retire, a little bit sooner. Like it's probably not going to be 35, it's probably not going to be 40. Probably gonna be a little bit earlier than 65 though, and that's like my main goal. And like I love being able to focus on that. And I think real estate's like the best tool. I
Yeah.
do want to poke fun at you a little bit from what you said earlier when you joined the pod. You said that you spent about like 8,000 times you check the stock market and see what's happening on a daily basis. So
Yeah.
as much as like all of us are, doing our own thing, like we become obsessive over our numbers and over our finances just in general. And I think you see that in both scenarios. But to your point, you can obsess over it and shut it off, where Ty and I can obsess over it, and then like we're still gonna have to call a plumber to go do something. Like there's a little bit
Yeah.
more actionable items after we figure out what our problem could be. So you're 100% right, but working harder is exactly true. That's why you see a
Yeah.
ton of people want to make it to America so they can work extremely hard and build a life for themselves.
Yeah,
Yeah.
I always say I want to get Steve a one of those stock tickers that just has VTI, because it's like funny because he invests for like 30 years, but he'll text me over like a 1% swing, and I'm like, dude, it doesn't matter. You
Yeah.
shouldn't even be looking. You shouldn't even be logging into your 401k account. Maybe once a year, but yeah,
I'm
I have a
embarrassed
lot.
to admit that I do check them frequently, meaning
Yeah.
many times a day. It's just what I do.
No way.
I think, but I
Um,
think
You
I'm not
can't
alone.
claim that real estate makes you think and get so much time and effort, and then like you're
No,
spending this extra time.
Yeah, but I
and
have it
effort.
on my watch. I just check it right now. But Don, check.
I
That's fair.
100%
That's
agree
fair.
with him. 100, like without a
Yeah.
doubt, I spend one mental and to your point when I said I think about it every single day. uh, And Tommy, I don't know if you feel this way. I can't shut it off even if I want to, right? And there are times that I do want to and I can't, which maybe I have to learn, but not even just mental, like and this is my next question is going to relate to this. But literally yesterday I spent 8 hours burning sticks and shoveling dirt because I own a house and I wanted an acre, and that comes with upkeep. And almost every single, like for the past half a year, I've spent probably half of my weekends fixing up my house, and that's because I bought a house for mostly for financial reasons. But that's actually I do want to get into some real estate specific questions, and the
Well,
first one is, should everybody buy a house that can afford it?
wait, I did have to say one thing before we move on. Sorry, and I do want to answer that question. Cut this out and then ask it again. But what I wanted to say was, I have never spent a weekend working on my house, and I've also never spent pretty much a dollar on my house or anyone else's house. And to me, that's huge because, and I want to get into this later, I'll ask you guys later, but like I see certain times where Ty will text, or I just figured out, he tells me, oh, I just had to do this, it was $5,000. Or you guys talk about it in this pod all the time, I just had to do this, it was $10,000. And I'm like, I don't know where you guys are getting all this money at all the time, where you're just like dropping 5 and 10K like all the time. And to be honest, like that's a huge opportunity cost. And that is where I'm like doing the math where I'm like, you know, every time you guys do a repair or do something for 5 or 10 or even 15 or $20,000, I put that into the market. And like, I know you guys are getting money back on that, but so am I. So I don't know. That's really interesting. And I actually don't think I would like to live in a stressful life where and I know you guys also have been going through it a little bit in the last 12 months, especially with a few of your properties, but still, I just wanted to say that, like, that's, to me, that's a huge difference. It's like, I don't have that stress.
I want to say that I look at real estate right now as I'm still young and learning. Not all of my properties are getting me 10% beating the market. Like for sure, I've put a lot of money into real estate, and some of my properties, like my first primary, I put down like 13,000 and I had like 130,000 in equity in 4 years, like 10x in like 4 years, just because of COVID appreciation.
Yeah.
The property me and Tommy bought together with seller financing, we're killing it ROI. But I also have like my 2 other properties that aren't doing as good as probably VTI. The thing is, I'm okay with that because I look at it as like I'm learning to get good at real estate, and it just takes trial and error, and you're not gonna hit a home run every single deal.
Yeah.
So that's fine. I want to make it clear. I'm not sitting here saying like, oh, well, we get 50% ROI on every single real estate deal that we make, because that's just not true. Most investors are happy with like 15, or like when they run their numbers, they want it to hit 15. And that's cash on
They
cash.
try to make it worth. They try to make it worth that extra risk and effort. Because if not, they're like, let's just put it into the S&P and get the 10% return. So if you're going to work a little bit harder and like have that extra risk, you want to get a little bit more reward.
All right, this episode was going a little bit long, so we decided to cut it in 2 parts. So we're going to end here and tune in next week for part 2.